Picking stocks. When you are selling a stock, someone else is buying it. Okay, what made one person buy and the other sell? Let me rephrase that question. Buyers think the price is too low and likely to rise. Sellers think the price is high and likely to drop. The puzzle is why buyers and sellers alike think that their current price is wrong. The efficient market hypothesis, or EMH, suggests that the markets are efficient. If so, what makes one person buy and another sell? When both parties have the same information, and that's reflected in the price of the stock. I love this cartoon. Also, the stock picking genius got it right. I bought my first stock, and it went up 5% in 1 week. That means I'm a stock picking genius. I plan to max out all of my credit cards and become a day trader. The total market was up 6%. That's just luck. Can't do that forever. Or did he? Stock picking is all about active management. Whilst there is a big debate going on about this, we'll discuss this later on. For now, let's be proactive. Yes, it's tougher, but that means the results will be worth fighting for. Picking stock or selecting the best stocks to trade is something you need to learn. The two common approaches are the top-down approach, starting with the industry and filtering down, and the bottom-up approach, starting with the companies and evaluating up. There are a couple of questions to ask yourself about the company. Is it safe? Is it profitable? Is it shareholder friendly? What you may have not noticed is that I'm not asking what is the company's future prospects. That's because I can't predict the future. Instead of looking at what-if projections, I'd rather look at as-is projections. This is pretty much what Warren Buffett is doing. He's looking at the existing business. Has it been consistent? Yes. Well then, you can pretty much be assured that it's going to continue being consistent. Anything above that is icing on the cake. Startups, as a result, are a challenge. You really can't predict the outcome because of the lack of history. Now you may be wondering if this is my criteria. Why am I big fans of trends? I'm not contradicting myself. Investing in a trend is different from investing in a business. Trends are for different periods. The business may be for good, but the trend could be up or down during that period. That's why I also dive into cycles, because the cycle is a combination of up and down trends. Now let's see if these companies are safe. Is it a large company that dominates the industry? How long has it been in the business? Does it have a large market cap? Does it sell popular products or services that won't be extinct tomorrow? Does the cash flow cover in the interest payment? The second or third question that you should be asking is profitability. Consistent and growing revenues? Yes. Consistent and growing net income or profit? Yep. Consistent and growing cash flows? Definitely. What about shareholder friendly? Dividends? Share buybacks? Who knows? Share buybacks are actually non-taxable, so even if the shares are bought back, you won't get taxed. Even though the share price increases, that gives you a gain. Now, it sounds like it's too hard. Simple does not mean easy. There are shortcuts to stock picking. Number one, evaluating thousands of companies becomes a full-time job. So we can use scans to filter out the companies that are not worth trading and investing. Now, once you've done this, you can narrow down and increase your edge, and the chances for successful trades are higher. This may mean you have less trades, but less is also good. We're looking for the edge actually. We're being highly selective to increase our odds of winning. We use a combination of fundamental filters and technical filters. Stock picking alone will not help you build your wealth. In fact, Yale professor Roger Ibbotson and Paul Kaplan of Morningstar summarized their study. Differences in stock picks made virtually no difference to the variance in the portfolio returns. No one can pick the right stock at the right time. So be prepared to make mistakes. That's okay. You will anyhow. How do you address this? Asset allocation. And how do you spread your wealth over different types of investments? That's something we need to learn. If you find nothing to invest in, then invest in nothing. Very often we're looking for one trade after another. Don't. If your criteria is not met, don't trade or invest. Don't waste time. Take some time off to relax and enjoy the present. Don't feel pressured to make that trade. And is 175 million in 5 years possible? Well, if you were the best stock picker over the last 5 years, as per the United States Today or USA Today, you could have earned 175 million by picking the following stocks, starting with just around $37,000. Is it possible to know when to get in and when to get out? Just think for a minute and keep your skepticism aside. Maybe this is possible. So let's look at the stocks that you should have been buying. In 2006, you would have bought Corvell. You would have got a 275% gain. In 2007, you would have bought First Solar with a 795 gain. In 2008, you would have bought Emergent Biosolutions for a 416% gain. In 2009, you would have bought Select Comfort for 2,500% gain. And in 2010, you would have bought Entropic Communications for a 293% gain. If you followed this formula and just bought these stocks at those times, you would have made $175 million from just $37,000. Impressive.